Yo, what's up everyone? It's your boy Looney, and today we're talking about a strategy that feels almost too good to be true and almost to a point where it feels illegal or a hack, but it isn't. This strategy isn't about penny stocks, gambling on earnings, or chasing hype. This is selling options. Specifically, we're going to focus more on cash secured puts, and then we'll go over covered calls lightly. And it's how I consistently generate weekly and monthly income from the market without having to constantly guess what's going to happen. Before we get into the video, I do want to do a quick shout out to the Discord community. It is free to join. And then I also have a premium membership, which gives you access to my trade alerts, one-on-one coaching. There is a selling options course. I do giveaways. I have newsletters. You can check it out. All links to it are in the description. It's $8 a month. But anyways, what is selling options? Let's break it down the simplest way. And we're going to pull up SoFi to go over this example. And I own 400 shares of SoFi, and I got it through selling options. So when you sell a put, so let's go to trade and then trade options. Let's go out just any expiration, July 25th. When you sell a put, you're basically getting paid to agree to buy a stock at a price you're comfortable with. So that's this premium here. If we go to the sell put, this 0.62, 0.45, these are all the premiums that you collect from just opening this trade, meaning you get paid this up front. You don't have to do any other step. It's just simply that you will need the cash to set up this trade. So if I went to this $14 put, and hit continue, you do need $1,400 to do this trade, and you get paid $45 upfront. And then from there, we're going to get into what happens. And then on the other hand, when you sell a covered call is when you own the shares. So you have to own 100 shares, and you could own the 100 shares through selling a put actually, or you can just straight up buy them. However you want to get the shares, you do need to have 100 shares, which I do, and I have 400, and I am also running covered calls. So if you go to trade options, again, we'll go to that same expiration. Instead of sell put, we'll do sell call. Same situation. You're getting paid to sell a stock at a price, and also you already own. And it's a price that you're cool with either selling or that it's not going to hit. And you feel confident it's not going to hit that in whatever term you choose. I'm more on that aspect because I do want to hold SoFi for long term. So I don't really want to get assigned. So I'll choose deltas that are a lot lower. So my chance of assignment is a lot less. So if you went to this $18 call, you'd get paid that $27 because it's times 100. And because I have 400 shares, I could do 4 contracts. And remember, the price of this is just owning the shares. You need to own the shares to do this trade. And I'm getting $108 in premium. Goes to my buying power. I could do whatever I want with those. I can reinvest it into SoFi. I could do it into other positions. Or you could buy calls, whatever you're looking to do. But in both cases, selling a covered call or selling a put, you're acting like an insurance company. You're collecting those premiums up front and only having to deliver if the market moves in a certain way, which is very unlikely, and it's more of an accident. So if something goes wrong is kind of where you have to deliver. So instead of just hoping the stocks go up, you're actually making money even if the stock doesn't go up. It just chills. And selling a cash secured put and selling a covered call are both bullish strategies. So if you're bullish on the stock, you can do a safe way, and that's the selling options way. And that's the way I mostly do it. And kind of why it feels illegal. Number one is you collect that instant cash up front. You're getting paid instantly. It goes into your buying power, and that's why I have 2,600. A lot are from premiums, and you could use whatever you want on that. Number two is you could use it on stocks you already want to own. If you're okay with owning SoFi at 14, if you think at 14 it's undervalued, you could sell a put and get acquired at 14. And if the stock goes below that, we'll get into the risk of that. But you already said that you were comfortable getting it at 14. And not only that, you're getting paid, like in the first point I mentioned. And number three, that it kind of feels like a cheat code, is you profit even if the stock doesn't move at all. Because if you just own SoFi straight up at 15.441 and then a month later it was still at 15.41, you would be net even. But if you sold a put or sold a covered call, you would earn that premium. So it can actually be better than just buying and holding stock. Number four is volatility. Volatility is actually on your side. It actually helps you. When the market's scared, option premiums spike. Or if volatility is high, or overall the market or the stock has high volatility where it jumps up significantly, selling a covered call, you earn a lot in premium. So you take advantage of any kind of volatility. The best part of this is you could control your risk. You could choose how risky you want to do, whether you want to do at the money. I've heard people do in the money cash secured puts or in the money covered calls. I don't like doing those. I like safer or just the usual strike prices. And that's that 30 delta, 45 days out. And you're not just buying random junk. You're getting paid to wait for discounts. One of the most important steps to all this is to choose a stock you want to own. I wouldn't choose any kind of penny stock or stocks that you're not confident in long term. And all these stocks I am confident in long term. And if you go to my options and my year to date, I'm up 1,700. And this is just unrealized. But if I go to my realized profit, unrealized, I'm up 5,000 or 55%. And this is majority coming from selling options. I did have a few buying options, but majority, 90% I'd say, is from just simply selling options. Now, I am using this strategy right now on Mara, SoFi, and Riot. I'm selling puts on Mara and then and Riot, and then I have covered calls on all three. So I'll sell puts on ones I want to own, and then if I get assigned, an assignment we'll get into, and that's essentially where you are forced to buy the shares. And then I sell covered calls once I own the shares. So let's get into what assignment is. So this $14 Mara put. Let's say, for example, I sold this put, $14. I got paid that $71. I opened it about a couple weeks ago, but I'm basically saying I'm okay with owning it at 14. Now, if the stock drops below that 14, I will get assigned. I will be forced to buy the shares at $14. So if it goes to $10, I am down about 400. Now, you might be thinking to yourself, why would you ever do that? Now, if I knew the future and I knew that it was going to go down to $10, I'd probably be a really good trader and I would be a millionaire by now, I'd say, because if I could predict that exact price movement, that's a very risky thing to do. Now, you could say, why not just buy a put? But even if you buy a put, you won't even earn that much. So if I went to July 25th and I thought it was going to go to $14, and let's go to buy call. So it says break even. Let's say we thought it was going to going to 14. So you just break even, and honestly, it wouldn't even be profitable. So if we went all the way up here, for you to actually make profit or reasonable profit, you go this buy put, and let's say it does go to 14, and we bought it basically there. You're basically making $20. So you'd be paying 600 or 700 just to make a few bucks. You could do a put debit spread that's a little bit more advanced, but overall, you can't really predict these things. So you're essentially just agreeing to buy the stock at a cheaper price in the future. And you're getting paid to just lock up your cash and just waiting for it like insurance. Now, if Mara stays above $14 by this expiration, which is in about 2 weeks or about a week, I will realize a gain. I'll get my cash back. I'll get $1,400 back. And then remember, I got that $71. So I'll make a net gain of $71, which is really good in about a month. And you're putting up $1,400, you could say, but essentially I'm okay with turning that $1,400 into shares. Now, similar with covered calls, if Mara shoots up, like I have this $16 call, if Mara shoots up to $16 by Friday, I will be forced to sell my shares. You can roll it, and I'm not going to go over it in this video, but it is one that I do. I like to roll. Or if the stock, well, I guess you're forced to sell your shares. So you'll be forced to sell your shares at $16, and that's not a bad thing. Again, you will really just miss out. So if Mara goes at $20, you're not losing money, you're just missing out on making those gains. And just for doing this trade, I got paid $42. So I did a roll, so it's a little weird, but overall, if the stock has to go past 17.45 for me to actually start missing out, which is a very far way. And that's why it kind of feels like a cheat code. It's crazy that you can make money with volatility in your favor and also not volatility in your favor. It's a very win-win scenario. Now, let's just review the risks because, again, there is some risk. You're not always going to win. It's not a risk-free bet. Number one is you do need to be okay with owning the stock. You have to be confident in the stock. You need to like the stock, and you just need to overall be okay with buying the shares. Number two is if the market crashes, you do get assigned at a higher price than the market. So if Mara goes all the way to $11 and I have this sell put, you do get assigned at a higher average cost, which can emotionally affect you and just seeing that number go down or your return be negative. So there is a risk with that. The way I combat that is risk management. You don't want to go all in. So you can see I have different puts at different strike prices. And this is essentially dollar cost averaging with options. And just lastly is that with smart strike selection and capital management, you can control the risk. Like I said, you don't want to go all in at a price. You want to do a little amount, and then if it keeps going down, you maybe double down or you do another strike price a little bit lower. So that's why I don't chase huge premiums with high deltas. When you go in the money, your delta is a little bit higher and the premium is a little bit higher, but it's a lot more risk. I do sell at lower delta puts, and I choose to do selling puts on red days mostly. And I get to collect consistent premium, and I don't force any trades. So yeah, this strategy feels almost like a cheat code or a hack or sort of illegal because of how consistently it works when done right. You're literally getting paid just to be patient. If you want access to my full strategy, trade alerts, and weekly callouts, join the Discord. It's free, and then the premium is only $8 a month, full course, one-on-one coaching, and more. Until next time, peace.